Baliga, our Chief Financial Officer, to this analyst meeting. All the participants are requested to note that the meeting is being recorded, and the audio and video recording of this meeting together with the presentation and the meeting transcript will be uploaded on our website as well as submitted to the stock exchanges. I would like to give you some brief on the important points for the smooth conduct of this meeting. All of you will be kept on mute mode to avoid any disturbance during the meeting. For the question and answer session, the names of those who have already registered with us as speakers, we will first allow them to speak, and then for the others, you can raise your hand during the meeting. If you have a question, you can put it in the chat box, or if you want to ask the question, raise your hand and we will then unmute you to ask the questions. Yeah. So now I request Mr. Mohan and Naren Baliga to present on the company's financials for the quarter and half year ended 30th September 2022 and take us through other related topics connected therewith. Mohan, over to you.
Thanks, Manohar. Very good afternoon to you, and thanks for joining us today. We will try to run through this presentation between Naren and myself in the course of the next half hour. I will try to give a little bit of our perspective on how the market's developing, how the economy is developing, and our own company in the course of this, and I'm open to any questions that you have. What you see here is a picture of a recent groundbreaking ceremony that we had for our polyurethanes applications development laboratory, which we will be constructing here at our Thane site. And it's essentially a commitment from our side to the growing demand that we have in the polyurethanes industry. So we're not just investing in the assets, but we are also investing in application development, which is a cornerstone to enable our customers do well, understand their challenges, and develop new products and applications. So this was a groundbreaking we had a few weeks ago, and this facility should be operational in Q1 of 2024. You might have read the press release on this, but I think it's important that you understand that we're not just investing into assets that are manufacturing, but we are also into research and development and joint development with customers, which enables us to have a deeper penetration into the Indian market. Before I go further about the customary forward-looking statements, only the matters in public domain will be discussed at this meeting. We do not provide any forecasts or future business situation, and also we do not comment or give guidance on future results or business outlook. That said, during the course of this, I will talk about the economy and how we see the economy at present, what we can comment. Starting with safety, I must say that 2022 has been an excellent year for BASF India Limited. You can see that the numbers are largely green, a few yellows, but again, no work-related injuries in the context of any fatalities. Also, the LTI rate has been well within the norms of the BASF, and a few first aid cases. But what's encouraging is the near miss reporting still at high levels, where the people are conscious of any unsafe act or unsafe actions and keep reporting it. And it is this culture that enables us to have a high safety standards. And I must say that even within our Asia Pacific region, we are the top performers when it comes to safety within the BASF group. So I thank my colleagues for making sure that we have this good safety record also this year. That maybe a little bit about what happened in the first half of this financial year, and I try to give a little bit of perspective on the various industries that we are active in. Let me start with the automotive industry. Automotive industry is a large portion of our portfolio, and this has been the best year for the passenger vehicle segment. It's an all-time high. The projection is we will end the year with 5 million cars being produced in the country. The previous best year was pre-COVID in 2018. In 2018, we were about 4.6, 4.7 million cars. And after that, we had a couple of years where there was a decline due to various reasons. You will remember the NBFC financial crisis. You will remember the change from Bharat 4 to Bharat 6. And then, of course, the COVID-induced and the chip shortage, which had an adverse impact on the passenger vehicle segment. What's happening there clearly is a strong, the chip shortage has kind of eased itself. The supply chain shortages are also reduced. And what you see is the automotive OEMs are manufacturing at high levels. And the demand for products is fairly high coming from the automotive segment. What's also happening there is a premiumization, if I may say so. And you see that the portfolio of the OEMs is shifting towards the city utility vehicles, the higher capacity cars, which then gives room for innovation for companies like BASF, whether it's in the field of engineering plastics or polyurethanes, or even coatings, because of the higher standards that the OEMs are setting up for the vehicles. We also benefit from that. When I take the two-wheeler segment, the two-wheeler segment is also going quite strong, but I think it's not at the peak yet. There seems to be a reduced demand on the two-wheelers, although it's recovering from the COVID situation. Here, my best guess is what we are seeing with rising interest rates. There is the cost of ownership going up is a little bit of a challenge. And you see that the two-wheelers are not as strong as they were a couple of pre-COVID levels. When it comes to construction, the demand is rebounding. You do see the commercial and real estate going up as well. However, this is another area which is quite interest rate sensitive, and with the current cycle of rising interest rates, that's an area which is a close watch for us at BASF as well, in the context of how the construction setup is going to develop in the next quarters and months. Agriculture, here I would like to spend a little bit of time because we had great expectations for the ag season this year, and the year started off with delayed monsoons, like all of you know. In the month of June, we were well below average. Then came July, where there was excessive rains in many parts of the country, resulting in overall the rainfall being well above average. Then we had a couple of months where we thought, well, now things are getting back to normal, but the rains never ended. Until almost Diwali, you had rains in many parts of the country, which meant a couple of sprays were missed across all companies, I would assume. Now, despite this, I would say that BASF has had a very good first half year in the context of our ag business, and Naren will probably talk about it in a second. And we've managed that simply because of introduction of new products. And here I would like to highlight that we've kind of set a record by having our insecticide exponents achieve a 100 crore, fastest to 100 crores in the industry, in our opinion. We achieved a 100 crore sale in flat 131 days, which was a spectacular performance for a brand new product. So new product introduction and having a very good preparation across the portfolio have enabled us to have an excellent first half of the financial year in the ag business. Now, I've been traveling a little bit across the country and meeting various channel partners and farmers in various parts of the country across crops. There are a couple of things which I observed during my trips. First of all, the expectation for the Rabi season is quite strong from rural India and the farmer community, especially because the water levels and the reservoirs are quite full. There seems to be a positive outlook for the season coming up. In terms of challenges that I see, there is what has fundamentally changed during this COVID and post-COVID is the credit system that operates in the farming community. Apparently, the financing, the microfinancing through the retail setup or the retailers in the crop protection industry is not as high as it was before. The risk-taking appetite there has declined a little bit. And I think personally, my takeaway was that this has impact not just on the agricultural setup, but what you see as an FMCG marginal slowdown is because of the fact that the farmers are having to self-finance a lot more than what they did in the past. As a consequence, I think the disposable income in rural India is a little bit impacted, and that's what we see also in FMCG. I mean, we've read the reports from various companies in that sector, and there seems to be some pressures. Of course, inflationary pressures are also there, but this credit pattern in the ag industry, in my opinion, seems to have some impact on the FMCG industry as well. Now, what you see on the FMCG and consumer durables, yes, there is inflationary pressure, and you see it's flat overall if you take at a country level. However, the premium appliances are driving growth, and that again comes from the metro cities and the tier 2 cities. I would say that's where you see demand which is quite strong in the consumer durables. In the chemical segment, I'll talk about it again towards the later half, but principally what we have seen over the course of the last 6 months is very volatile pricing. There have been commodities have been quite volatile in the last 5 to 6 months, and that has had impact and margin pressures across the chemical industry. However, the specialty chemicals industry has shown positive growth in the country, and I mean, as BASF, you know, our portfolio, we are spread across the entire chemical segment, and we have seen that the specialty chemicals seem to have a rather robust demand in the first half of this year. Overall, the manufacturing sector is strong, and we've seen that to be a positive development and a positive impact on demand overall in the first half of this financial year. With this, maybe I pass it to Naren so that he can lead us through the financials, and then maybe I'll come back later and talk about how do I see the months coming.
Thanks, Mohan. So coming to the financial performance, the first slide here shows our segments. We are operating in 6 different segments in India. And except for agriculture solution, you see at least 2 operating divisions in each of the segments. On the right side, the pie chart, materials happens to be our biggest segment, which has performance materials and monomers included, whereas surface technologies is only 4% of the total. Usually, interest is on agricultural solutions, and Mohan talked extensively about that. That covers around 15% of our revenue. And this is a well-diversified product portfolio that we have to serve customers in India. Quarter-on-quarter and half-yearly performance review here. On the left side, you see quarter-on-quarter, a 5% increase in sales, contributed both by volumes and better price realization. Whereas the margins have suffered. You might have seen this in our publication after November 10th. We announced these results. It has come down by 19%. Between the two, there's a difference of 120 basis points compared to a percentage of revenue. And I will cover the reasons for that when I cover the half-yearly numbers on the right. 16% growth. So April to September, we have a 16% growth. And again, PBT has gone down by -4%. And if you compare both, you can realize that the first quarter was significantly better for us. Obviously so. Agro was there, firing on all cylinders. And then other businesses also did relatively well. The second quarter of the current financial year was not that good, and that is what the result you see here. Main reasons for PBT being low is the higher input cost that we could not fully transfer it to the customers. We could not transfer all the input costs to the customers. And the depreciating rupee also against US dollar has impacted us. In addition to that, of course, there are other topics which I will cover later. Market demand was also low, and I think Mohan will cover that later in the Q&A session specifically. This is kind of a busy chart to show quarterly performance of sales and PBT on both sides. I started with the March 2020 because that's one quarter before the COVID hit. So that's kind of a normal quarter, 1,900 crores was there. And June was the first hit, 1,700 crores. And then it picked up. There was kind of pent-up demand, and we could sell 2,500 crores in September 2020. Over a period, you can see how it has gone up and stabilized at around 3,000, 3,300 crores over a period. And June 22, the last but one bar, 3,888 crores, is the best ever quarter we had in terms of sales. That's with all the businesses doing well, and especially agro doing fantastically in that quarter. And the September quarter is 3,600 crores, if I round it off. On the PBT side, June 2020 is the quarter where we had a negative PBT, minus 41, because the plants did not operate. There was complete lockdown. And then it picked up. Up and down, kind of a roller coaster ride you see here, with June 2021 and June 2022, both being the best of the quarters. And 264 happens to be a great quarter for us. I mean, the June 22 happens to be a great quarter with 264 crore PBT. Because of the reasons that I mentioned, market demand, product availability, rupee depreciation, softening commodity prices, we have a hit on the margins, which is resulted in the lower PBT of 149 crores. This is a waterfall chart to show how the 6,400 crores converted to 7,500 crores between the 6 months of this year and the 6 months of last year. Starting with agriculture solution, again, 185 crores more than the already very good 6 months of last year. If you remember, even during lockdown, our agro guys were in the field selling to the farmers, and we recorded around 1,000 crore sales, which we bested by another 185 crore, taking it up to 1,100 crores, agriculture solution. Materials, both performance material and monomers did extremely well, 400 crores additional sales compared to last year. And nutrition and care also 265 crores. Industrial solution, again, around 200 crores. The new Dahej plant has contributed a little there. We started it only in June, and slowly it's ramping up. It will take time to ramp up completely. The second line in Dahej, which doubled our capacity of dispersions. Chemicals is the only segment where we have a slight lower value, not so much because of volumes, but because of the price drop, significant price drop in the chemicals segment, both intermediates and petrochemicals. And we have shorter sales of by 23 crore. Coming to the same PBT before exceptional item by segment, how the 432 crore became 413, how it translated. Agriculture solution, already, like I said, last year was a very good quarter. Last 6 months, last year was a very good quarter, very good first half. And we bested that by another 71 crores this quarter, the 159 crore of PBT. Whereas materials is hit hard for the reasons that I mentioned earlier, and I'm sure this question will come up both for materials and chemicals in the later Q&A session. And I want Mohan also to explain from a business perspective how this happened and what is the current situation. The same topics come in there, the product availability, rupee depreciation, market demand. These are the things which are basically, and the softening of prices of commodities is impacting both materials and chemicals. Nutrition and care and agriculture solution happen to be very good segments for us. Since the COVID days, nutrition and care has been doing extremely well, and this is kind of improved every year. And this year, first half has been exceptionally good also in nutrition and care. Some key performance indicators which may of interest to you. Receivable days, we have 63 days, very well managed, very low overdues. And even during the COVID days, we controlled our overdue so well. We did not have any major bad debts during those days. So it's managed well at 63 days. Inventory, we import almost 80% of our raw material and finished goods. And with that, having some good inventory on the land is always important. Yeah? You don't want to lose the opportunity when the opportunity arises. So 60 days is, in my opinion, a very good situation to be in, neither on the higher side nor too low. Current ratio 1.8, current assets over current liabilities 1.8. Again, a strong ratio there. And the net working capital, if you have seen the earlier times in 2017, 2018, 2019, that time, we used to have 15% of our sales as net working capital. And that has been brought down to around 9% now. And for the financial year 22, it was 8.3%. Really good management of working capital, receivables, inventory, and also payments. On the right side, operating expenses, this does not include cost of material. The raw material and packing material is not included here. Personnel cost is not included, and depreciation is not included. So excluding this, the fixed cost has gone up slightly, also because of the commissioning of the new plant in Dahej, excluding depreciation again and personnel cost. But those are some of the reasons why it has gone up. But fixed cost is very much under control. That's what it shows here. EBIT before exceptional item at 5.6%, and EPS not annualized is 71.6, as against 135 for the full year last financial year. And that all adds up to ROCE being 17% against not annualized, as against 36% of financial year 22. I hand it over back to Mohan for.
Thanks, Naren. Before I get into what we've done as growth projects over the last couple of months, maybe a few remarks on the results that we just showed. I mean, the question on chemicals and materials, I mean, you would have probably followed the BASF Group analyst presentation as well. There has been a sharp decline in commodity prices, whether it is the petrochemicals or the chemical monomers or the intermediates, part of BASF's portfolio. The significant decline in prices. Typically, when that happens, customers also delay their procurement so that they can take advantage of the declining prices. So what you see there clearly, these are the two segments where we also had lower results than the previous year's first half, purely coming as a consequence of declining prices. And obviously, in the declining price environment, the time between when we buy the product and sell has certain implications. And also from a raw material perspective, the delay in transferring prices has an impact. So that's what you see as the decline in results from the chemicals and materials segment. In the other segments, you see clearly that the ag business has done really well, and that has been on account of growth in volumes, new products being launched, and better margins across the portfolio. Industrial solutions also has had a positive development, as was visible in that chart. Maybe I go back for reference. And in the case of surface technology, we're still negative. You would remember about a year ago, I mentioned to you that we are working on improving, especially our coatings business there. And you can see quarter on quarter, we have improved our performance. It's still not out of the woods, but essentially it's been about increased presence at the customers. It's been about price increases and keeping the costs under control there. And slowly but steadily, we are seeing a positive development in our coatings business. And I'm pretty confident that in the coming quarters, we should be able to, again, have a positive number rather than a lower negative number that I'm showing here at this point in time. So overall, you can see that the ag, industrial solutions, surface technologies, and nutrition and care all did better than the first half of previous year. And the material segment and chemicals were impacted by a sharp decline in commodity prices, which happened during the second quarter of this financial year. That said, we are keeping the inventories rather low of these products to avoid any kind of write-downs based on net realizable value. So making sure that we keep the inventories at the shortest period possible for these commodities where we see certain volatility happening due to the global situation on commodities. Coming back to the growth projects, on the left side, you see at Dahej, the capacity, we doubled the dispersions capacity. We started production in June, and we are slowly ramping up. The products are qualified at customers, and I'm pretty confident that we should be able to ramp up the capacity utilization and fill up this plant in the course of the coming quarters. I talked about the groundbreaking of the new polyurethane application lab as the first slide. And clearly that's our commitment, continued commitment, that we see a strong potential for growth in the polyurethane business in the country, and with our assets in both Thane and Dahej, we are well positioned to leverage the demand growth coming from this segment. Also on the utility side, keeping our costs under control, we've inaugurated new facilities in Mangalore. We are also leveraging the possibilities of renewable power at Dahej and Mangalore, thereby ensuring that our footprints are also reducing on a year-on-year basis, well in line with our global commitment to achieve net zero by 2050 and to reduce our footprint by 25% until 2030, with a baseline of 2018. Now, at the customer level, we continued our engagement with customers. You see a few pictures, whether it was on the bottom right, a manufacturing and supply chain session from the automotive industry. You see certain other pictures which are about inauguration of our stall at various Chromatex, Chem. You see the Indian Medical Association where we participated, and over 250 doctors about medical education with regards to our crop protection chemicals, and that was well appreciated by the IMA. And on the top right, you see at India Chem where we were participating at the CEO Roundtable and the inaugural session and receiving an award from the Honorable Minister there at the award for impact on the industry. Lastly, what I would say is, I mean, you see this slide every time from me because my focus areas and the team's focus areas don't really change. We are strongly focused on operational efficiencies, our customer engagement, and our people. The levers there stay the same. We just have to work a lot harder on topics like margin management and cost control because of the situation that we are in at the moment with the global geopolitics. And the impact of the crisis still in Europe, which has its impact on commodities and the margins, hence managing margins and working capital and making sure that our cost base is under control is the primary focus that we have as a management team. Yes, there are challenges of currency fluctuations and inflations in the market, which we also foresee could have an impact on some of our segments. We talked about consumer durables, where we have some exposure with our materials business. where there could be a challenge because of rising interest rates as a consequence of the inflationary environment that we are in. And last but not the least, energy prices, whether it's gas, electricity, is going up and it continues to go up. We do not really see a softening there. The raw material prices, well, they are volatile at this point in time. The commodities have seen a crash from their highs of last year, and we have to manage the volatility. So the challenges stay more or less the same. The outlook from an economic perspective, we still see that for this financial year, whether it's the automotive industry, the ag industry, the second half will continue to have a reasonably solid platform. However, when it comes to consumer durables, we see it a little bit weak. FMCG, we see a little bit weak simply because of the fact that the higher interest rates and availability of credit, especially in rural India, the change in pattern will have impact on demand in these segments, is our view. Now that said, our focus continues to be on growing our business in volumes and making sure that we manage our margins by keeping the costs under control. We engage very strongly with customers, and that's something we continue to do. A lot of new projects, new ideas for innovation, new products for launching over the next few quarters, and that's where the whole company is focused on. I'm happy to take any questions.
Yeah, thank you, Naren, for the presentation. We have a few speakers who have already registered, but I also request if anyone wants to speak, they can just raise their hand in the Teams, and we will at the relevant time open up the line for you as well. So we have the first speaker. He's from Brindstone Investments, Mr. Varun Bang.
Hello,
are you online?
Hello, am I audible?
Yes.
Yeah.
Yes,
So good, and thank you for the detailed presentation. I have a few questions. I will ask 2-3 questions now, and then I'll join back the queue for more. So the first question is, we have seen a lot of volatility in the first half of the financial year. So whether it is in terms of currency, in terms of availability of raw materials, and also supply chain, and you spoke about it during your presentation, but it would be helpful if you can just quantify the impact of these factors on the financial performance of the company during H1. That would be helpful. And in the same context, what part of the impact is transient and what portion will have more entrenched impact on the operating performance of the company? That is something if you can just highlight. The second question is how, given the how situation is evolving in the Germany, how it is impacting our operations in India from A, our cost competitiveness, B, continuity of supply, and C, our future expansion plans in India. So how are you dealing with this situation? And third question is on agrochemical segment. So we've reported strong performance in that segment. If you can just highlight reasons for this performance and also talk about the pipeline of products and share business prospects going forward.
Thanks, Varun. Maybe I answer in reverse order. Firstly, on the ag segment, like I mentioned, we had a very good preparation for the season. Our product placements were good. We also had the launch of 2 new products which contributed significantly to the growth. Like I mentioned, the product Exponus, we had 100 crores within 130 days. That's kind of a record for us, if not for the industry overall. And even our other product, Westnet, in the sugarcane market also did reasonably well. So the 2 new products added quite a bit to the overall growth, and our existing products as well. Through efficient planning, supply chain, you know of all the crisis that in terms of shipping availability and so on, but the team did a fantastic job to ensure that our products are available in the markets. And also from a technical perspective, our people were out there in the field conducting several farm trials, also through digital media, through Facebook Live, and so on. to make sure that our presence and reach in the market is quite good. And we believe we've done a lot better than our competitive environment in the domestic market for agrochemicals. And that's a pretty solid performance going forward. We do have a list of products that we will, through life cycle management or new products that will come up in the course of the next years. There, some of them are under registration, so can't exactly say when they will be out, but I see a continuous pipeline of new products in all segments, insecticides, herbicides, and fungicides, where we will continue to introduce innovations to the market. Now, on the question regarding Germany, so Germany, we've done a very detailed risk analysis of what's the impact of the crisis in Europe, the natural gas from an economic perspective, from an availability perspective, and also from a customer downstream perspective, what are the kind of impacts that we would have as an organization. And we did this pretty early. I mean, the war started end of February, so we as a board have reviewed this several times in the course of the last 6 months. And I'm pleased to let you know that there was no material impact of the war on our operations here in India. In any context, we were able to secure the raw materials and the finished goods that we require for our business here in India through careful planning and making sure that we do a little bit of advanced planning and keeping a little bit of higher stocks in the areas where we were, which were critical in nature. Now, coming to the price impact, it's not just an India impact. What you see, the consequence of the expensive natural gas in Europe led to a commodity spike all across the world. I think with the exception of the United States, gas prices across the world have gone up. And wherever one could replace gas with other energy sources, one has done that. But when it came to building blocks where gas is used as a chemical constituent, there you don't have much of an option, and you have seen inflationary pressures across the value chain where natural gas is a raw material. And here we've been successful in passing those costs through. In some cases, there have been delays, but overall, we've been quite successful in passing through the inflationary environment caused due to gas prices in Europe. Manoj, remind me the first question.
I think the question was on the volatility in the currency and the availability of the supply chain. How does it impact our performance?
Yeah. So again, the biggest impact that we saw is in the context of volatility of commodity prices. We did not face an impact on availability. The availability was reasonably good. We were able to secure that. However, there was price volatility in the context of whether commodity petrochemicals or chemical monomers like the isocyanates. There was quite a bit of a drop, and then it went back up again, and then a drop again. So we're seeing volatility in those areas. So hence, we managed that to the best extent possible. We did not really have an issue with currency or forex losses. That's really not an impact for us. We have been able to pass through the increased costs that come in through these measures. The biggest impact that you see, and what Naren presented in the context of chemicals and materials, how we performed compared to the first half of previous year, that came from the volatility in prices and the sudden drop. And of course, when you have a 4-week sailing time between the time you buy and sell, there is the 4 weeks that you have to deal with. And when the price sharply declined in the second quarter of the financial year, we did have an adverse impact. And it's principally on account of this commodity prices and nothing, not really any impact to foreign exchange.
Thanks.
I hope, Varun, that was okay.
Yeah, thank you. I'll join back the queue.
Thanks, Varun.
Thanks. We have the next speaker, Chandrasekhar Padiyar from Tata Mutual Fund.
Yeah,
Mr.
thank
Patia?
you. Good evening. Yeah, can you hear me?
Yes, yes, go ahead.
Yeah, great. Okay. Thank you and good evening, sir. I have a few questions. Maybe first a generic question, actually. Since you've taken over as MD, you've been highlighting your focus as a profitable growth and you've actually delivered amazing performance. In FY23 first half, profits are there, but growth is missing. And in your presentation, you still mention profitable growth. Do you believe the second half can pick up on the base of last year? Second half looks a bit lower, so maybe you may deliver a growth this year as well. But still, I thought I'll check on this. This is a generic question. On a specific questions, your trading portfolio is pretty large, and in an environment where growth is slowing down and commodity prices being as volatile as they are today, how easy or difficult is it to pass on the higher commodity prices in a slowing environment? And going forward, let's say over the next 6 months, would you be able to pass on and manage to maintain margins in the trading part of the book relative to last year is the question that I had. The third is on care chemicals. You mentioned, or let's say you mentioned weak FMCG performance expected in the second half of this year, continuing. But your care chemicals portfolio has done pretty well on profitability in the first half this year as well. Would you say that this can get impacted in the second half or going forward basis? That's the third part. And lastly, on CapEx, on new projects, in the past, you've mentioned that there are new projects on your drawing board under consideration for manufacturing in India. Given the way things are globally, would we expect something going forward on that count? These are the 4 questions that I have. Thank you.
Yeah, thanks. So firstly, in terms of profitable growth, yes, we continue to strive for profitable growth. And Naren showed in the slide that we had on a half-yearly basis somewhere around 15-16% overall growth in revenue. Now, if I remember this correctly, Naren, half of it came from volumes and half of it came from prices. So despite the challenges that we are facing, commodity prices and so on, we've actually increased realizations by about 7 to 8%, and we've grown volume 7 to 8%. Yes, profitability was impacted due to the declining commodity prices and where we have some delay in the context of the declining environment when we buy at a higher. And your question about trading margins is absolutely correct. And that's where we try to shorten our cycle and ensure that we still have a respectably healthy trading margin. I wouldn't give a forward-looking statement, but clearly that's a area where Naren, myself, and the business heads are very sharp on and make sure that we don't have a sustained impact on it. Okay, a one-off when it happens in suddenly, let's say a commodity price drops by 30% in a quarter, then of course you will report a certain hit in that quarter. But overall, this is being well managed in my opinion, and the outlook is also that we should be able to continue profitable growth going forward. Then on the topic of
Care chemicals
and nutrition, the big increase that you see there came more from the nutrition portfolio rather than the care chemicals portfolio. But of course, it's the same segment for us. Now, outlook, again, like I mentioned, the FMCG, I see it to be challenged in the second half of the year as well. But you will recollect that in a couple of quarters ago, we did have poor margins in there. So what you saw as an improvement from about 9 crores to 53 crores came as basically we made sure that we are coming back on track. And I think we should be able to sustain the current levels of performance in the care and nutrition area. Regarding CapEx and investment in India, it's an ongoing exercise where we continuously review the market, what's the opportunities for BASF, where there is critical size for us to evaluate investments. And this is a regular exercise that I do with my BASF global management as well. And I must say that in the last few quarter, I mean, like you here with the PLI schemes, I mean, just yesterday, I think the secretary for DCPC made a statement that there will be a PLI scheme for chemicals coming out soon. And obviously, these kind of topics are encouraging for us as BASF to look at our portfolio and see where we can come up and invest in the country for local manufacturing. That said, I don't see a situation where BASF will have 100% local manufacturing and no, I mean, even in practically every country, you will see a significant amount of the traded goods because BASF believes in building plants which are world scale in size. And then there is, you can't build one in every country. Then based on what the strengths are of the country, how the demand pattern is, we build for local market, but always 20 to 30% will also have exports coming from the local markets as well. So the way I see it is we will always have a strong trading portfolio, which we will need to manage. And my organization is aware of that. And therein managing the working capital cycle, managing the margins, that's where the focus is for the trading business. And on the investment side, yes, we've heard a lot about China Plus One strategy, which so far has positively influenced the field of agrochemicals and pharmaceuticals. But what you see now is more and more opportunities coming up in the building blocks. I think a couple of years ago, I talked about this to you, that this is what the country needs, that we need to have more investments into building blocks. And I think now comes a time when these opportunities will come up. And like I mentioned, the statement from our secretary, DCPC, on the chemical side, a PLI is something we look forward to, what comes out in that announcement. And hopefully it also benefits our own portfolio.
Okay, thank you, Mohan. The next speaker, Mr. Bharat Seth from Quest Investments.
Hi, thanks for the opportunity and congratulations, Mr. Mohan and team. And reporting a reasonably good performance in very challenging time, and because of the whatever last 3-4 years of effort on the team side to build and grow, profitable growth. Sir, my question is, you referred to about China Plus, but now there is a talk also going on Europe Plus One. So I'm not saying that everything will be manufactured for BASF in BASF India, but in your fair opinion, which are the sector where you think that India can, for our company, manufacturing can India really be a possible, and we can build a large scale plant. And second thing, on AgChem side, can you give some more color on the product pipeline and how do we really see from those products, to contribute, because agriculture is a most priority for even government in India also to improve the productivity, and which are the products that you think can really play a better role. And NutriCare, of course, we have doubled the top line. Reasonably 20% is contribution is coming from the overall business. So do we think that in NutriCare, can we really put up a manufacturing? Thank you, sir.
Yeah, thank you, Mr. Seth, for your questions. So on the context of portfolio for potential investments, that is, we always evaluate that. At the end of the day, it's about how the industrial setup in the country is developing and where it gives opportunities for BASF portfolio. So I can't give specific products today that this is what we are evaluating or this is where we will invest. As and when we have a decision at our board as to which areas to pursue, we will inform you and the stock exchanges at that point in time. Then when it comes to the ag business, I did mention that we do have a pipeline of products, whether it's insecticides, herbicides, or fungicides, all three, which we have a robust pipeline, which we are going to launch in the coming years. To say the least, I mean, we are quite positive and optimistic about the business and the demand for our products in the years to come.
Which sectors we see where we can go for local manufacturing? I mean, in general, as
yeah, that's again, like I mentioned about the industrial growth in the country. I see a few areas where we already are present. So, for example, when it comes to serving the automotive sector, when it is in the construction sector, here we are already present with our current investments. Now, looking at building blocks, how that develops and where we get critical mass to have a global scale plant. Till today, the way I see the chemical industry is when it comes to refineries, when it comes to cracking, when it comes to upstream polymers, we do have global scale possible in the country, and you see a lot of investments. If you followed the McKinsey reports at India Chem, and PwC as well came up with a report. The investments that are lined up by various large corporates is in the field of refineries, is in the field of crackers, is in the field of upstream polymers, and the mid segment, which is where the BASF portfolio is. We still don't have the critical mass as a country, and I can tell you the same example. 20 years ago in China, it was the same discussion. But then as the industrialization, as the Make in India thing develops further, you will see that there will be global critical mass for some of these building blocks as well. And that's when it gets interesting for BASF's portfolio. So we're not there yet, and which is where BASF is continuing to evaluate that situation. And when the time is right, you will hear more from us. And lastly, you had this question on Nutri and Care. Whether we can invest over here. Well, again, you can't just have an isolated investment. It's part of a value chain. So you need more possibilities in the context of overall development. We have invested in the care chemicals business, for example, with our plants in Dahej. And as and when we have an opportunity, we will review that and see whether we can further localize the manufacturing in the country. But for now, I think we are in a good space with our portfolio where we are, and the focus is clearly on making sure that we grow the market so that in future we should be in a position to invest.
Thank you very much, sir. If with your permission, can I take one more question? I mean,
sure.
Sir, on agri-chemical, also I understand that our large almost everything is 100% imported. So are we evaluating anything on ag chem side, local manufacturing?
We are evaluating, like the rest of our portfolio, we are looking at our ag segment as well, both in the context of our active ingredients as well as formulations. And like I said, whenever we come to a decision on those topics, we will communicate to you along with SEBI. At this point of time, it's under evaluation. We think the ag market is quite an attractive market, and that's something which we will come back to you as and when we have come to a decision.
Thank you very much, and all the best.
Thank you, Mr. Seth. The next speaker is Rohit Nagraj. He's from Centrum Broking. Rohit.
Yeah, so thanks for the opportunity. So first question, Mohan sir, is on the segments which are showing some kind of a demand contraction on a QOQ basis. So which are the sub-segments which are showing demand contraction in a domestic context? And I mean, what are the particular reasons why these particular segments are showing demand contraction? Thank you.
Yeah, thanks, Rohit. I mean, the demand contraction we largely see in the chemicals space, in the commodity space. And I think a big element of that is people expect a declining price environment. And typically what happens is in a rising price environment, people tend to stock up because you benefit from the inventory gain. And in a declining price, every customer of ours is trying to avoid an inventory loss. So they cut down the inventory levels significantly. So I see that the big commodity chemicals that we have is seeing a certain decline in demand, principally coming from inventory correction to a large extent than the end demand. Now, to some extent, we do see, like I mentioned, the FMCG, which is then somewhat reflected in our portfolio as well, that we see a slight decline in demand, or let's say a very low growth rate in some areas. But the big ticket items like agriculture, automotive, construction, here we continue to see very robust demand.
Right, sir. Got it. So second question is in terms of, I mean, you travel across, different countries and, Asia. So what is the sense in terms of the exports demand? Are we looking the exports demand somewhat stabilizing or getting impacted because of the global issues? I mean, there's a generic question from the exports happening from India because we have very limited exposure to that particular segment. Thank you.
Yeah, so you're right. We have very limited exposure in the context of exports. But now overall, speaking from a chemicals perspective, I think the exports are quite robust. I mean, if I look at purely just the ag chem sector, many of our peer companies which have a significant higher exposure in the context of global markets, whether it's Europe, North America, or South America, they have actually reported much better results outside of the country than in the country. So you see that there is demand for exports, whether it is agrochemicals, whether it is dyestuffs and so on. So we are seeing that there is a robust growth there. On the pharma front, I see a muted, I don't know why it is so, but somehow post-COVID, there seems to be a lesser, at least the ones I've talked to are complaining about lack of growth and a little bit of stagnation on the pharma side, which then also reflects into the chemical intermediates that we supply to them. That said, most of my peers are quite bullish about development of exports going forward. So I was part of this CII survey, and probably it was published as well, that people are still expecting a pretty robust growth despite the challenges in the world. Sometimes I don't understand why, but people are still quite optimistic about the export potential from India. In terms of the confidence index, maybe I just close this with one statement, that in terms of confidence index, from last quarter to this quarter, amongst most CEOs in whether it's CII or FICCI, it seems to have come down a bit, but not so much. Yes, please, well, go ahead.
Yeah, just one last question, if I can squeeze in. In the initial remarks, we indicated that about 80% of our raw materials and merchandise products are imported. Now, given that the rupee has depreciated quite a bit, will this have any impact on the domestic demand, given that the prices of these products will certainly increase? And an allied question to that, these products, I mean, some of these products must be coming from our BASF parent in Germany. Will there be any challenges to source those products because of the unavailability of maybe natural gas feedstock in there? And currently those products are manufactured in lesser quantities. Thank you.
Yeah, so on the second part, we haven't faced a challenge in the context of securing our raw materials or traded goods from our parent company or any of our group companies. That's been very well managed with careful planning and supply chain. And wherever we've had an issue, we've been able to mitigate that with the various measures that we've taken. In the context of demand, you are absolutely right. And it's not just an India topic, it's a global topic. I mean, whether you read the minutes of the Fed, I mean, they want to tame inflation as well, and they don't mind having a demand contraction as a sacrifice to tame it. So that's what the Feds are telling you. Now coming to India, yes, there will be inflationary pressure as a consequence of rising the feedstock prices across the value chain. You see that, I mean, every automotive company is raising prices. So there is inflationary pressure across various parts of our consumer portfolio. Even as private individuals, you and I think, are paying for vegetables, for anything that you buy, you pay more than what you paid a year ago. So the inflation is there. Whether this now is having an adverse impact on demand, well, economics tells us, yes, it will have an adverse impact on demand. But so far in my portfolio, I haven't seen that, which is why we have reported an 8% growth in the first half of the year. Now, going forward, how will that impact in the next years is something which we have to see how the quarters develop and how much the interest rates goes up in the context of consumer financing. And most important question towards this time of the year, which all my employees ask me as well, is what will the company do in the context of inflation? What will be the salary increases next year? Where across the corporate world, if salary increases meet inflation, then I think the demand will stay. If salary increases are below inflation, then we'll have a challenge.
Right, sir. Got it. Thanks a lot for answering all the questions and best of luck.
Thank you.
Thanks, Rohit. Please, again, if there are anyone who wants to ask questions, you can raise your hand or also put the question in the chat and we will be happy to answer that. The next speaker is from FSSA Investments, Masira. Are you there?
Hi, I'm here. Sorry, my mic just got enabled. Thank you so much for the opportunity. I have two questions. One is recently the parent talked about permanently downsizing in Europe. So maybe could you help us understand what that might mean for the business in India? And second, I know it's sort of a long time away, but in Asia, the Verbund sites have usually been joint ventures. If that were to happen in India, would it be through the ListCo or how would that come through? That's it from me. Thank you.
Thanks, Mashira. The first thing about downsizing in Europe, I mean, Martin Brudermüller, CEO, made that announcement very clearly. The areas where we are downsizing, where we are looking at cost-saving measures, I do not see a direct impact on any of our activities here in India as a consequence of this. So I see that our operations will continue as it is despite the downsizing in Europe. Now, what's more important is what happens to our facilities, how are we cost competitive coming with production out of Europe, and what kind of mitigation measures we as a company need to do to ensure that our supply lines for our raw materials and our traded products are cost competitive for the Indian market. And here, mitigation measures are taken at a global level as well as at a local level to ensure that we get, I mean, the war's been on now for 9 months, and I can clearly say that none of our supply lines have been disrupted during the course of this year. And I'm pretty confident that we will maintain pretty good availability of our products and raw materials for our plants and customers going forward as well. On the question whether if there is a JV as a Verbund, whether it will be from the listed entity, I think it's like you correctly mentioned, it's too far away, and I wouldn't speculate on that today.
Got it.
Sorry, I can't.
Fair. And just sort of, sorry, I think you've been asked this in many different ways, but just expanding on the first question, with the way you're trying to manage your inventories and traded goods, do we see more opportunity for India to do more? I think that would be very helpful to understand.
when you say for India to do more means India to invest into local manufacturing. Is that what
Yeah,
it means?
yes, exactly.
You know, the philosophy for BASF in terms of its investment is that we invest for assets for the local market. We do have exports, which we opportunistically export to make sure that we have high loading of our plants, because when we invest for a few years so that the plant gets filled in 3 or 4 years. So typically we have some export opportunities. Now, like I mentioned before, the question is within BASF's portfolio, which lies somewhere in between the entire chemical value chains. The critical size is very important for us. And that's where I think whenever we reach the Indian market gives us an opportunity to invest, BASF will invest. But at this point of time, it's not like, we have a cost situation in Europe or we have a challenge in Europe, so now we will invest in India. That's not how BASF works. We need to have a situation where the markets provide us adequate demand, a possibility to be economically competitive with conditions of raw materials and utilities, and then overall a sustainable framework coming from the government. So I think the framework from the government over the last few years has significantly improved. When it comes to cost competitiveness, yes, that's under discussion in various aspects, whether it's feedstock, whether it's energy. And lastly, when it comes to the size, wherever we have seen that there is size for investments, we have invested locally, and also going forward, that will be our principle. So we will keep evaluating opportunities within our portfolio. When do we have the opportunity to invest locally?
Thank you. That's really helpful.
Thank you, Masira. The next speaker is Rohan Gupta from Nuvama Group.
Yeah, hi, sir. Good evening and thanks for the opportunity for letting me ask the question. Sir, first of all, congratulations on a group BASF as the leading chemical company and sustainably performing almost third year in a row, where we have seen historically the profitability of the company has been quite volatile, and this is probably the third year where the profit growth has sustained on the absolute basis. Sir, my question is, maybe you may find it quite repetitive, but sir, it's a surprise for me that BASF globally is a leading chemical company, and thankfully you have a presence in India. You have operations in India with a quite diversified product basket. We have seen, I mean, at least the industry outlook or the many chemical companies outlook on the domestic as well as in export market, whether in specialty agrochemicals, intermediate manufacturing, is quite promising, quite robust. That is getting reflected in the many companies getting very aggressive in a chemical capex plan. So if you see that most of the chemical players have accelerated their capex plans in last 3 to 4 years and going massively because they see that it's a never seen opportunity for them in a chemical industry, not only just domestically but as exports opportunities as well. I wonder where is a disconnect between the BASF and other domestic players who see that there is a huge opportunity for them, and even the players like BASF giving them the comfort, or a buyer, and I don't want to name every company, but a global innovator and global companies giving them the comfort that yes, go ahead with the capex and we will buy from you because we want to reduce our dependency from China or the Europe crisis and all. And here, even our own baby, I mean a global BASF's baby sitting in India, uh, almost sitting silently, just only generating cash, huge cash is inflows, piling up. I'm on a cash inflows, while you may have a huge opportunity to invest in India, even have a huge financial availability from your parent company, debt-free balance sheet, a significant cash flow generation, and the most important thing is the capability and also your own parental advantage where you can do a lot of job work or work for them. I know I have taken a long time in explaining my questions, and pardon me for that. But sir, it's a big disappointment for me that where is the disconnect? Why we don't see this kind of optimism even the BASF India, while many domestic players are so gung-ho on this opportunity. They say it's a once in a decade opportunity. So I just don't know who is right, or we are just getting too conservative about it.
Thanks, Rohan. Thanks for that question. Um, Life is not so black and white as you describe it. The point is, when BASF, you talked about companies like BASF and Bayer talking to the local players and let's say contracting certain molecules or manufacturing. I presume you are talking about segments like the agrochemicals. I mean, that's probably a strategic decision by BASF from a technology perspective that this manufacturing will not be done by BASF, but will be outsourced. It might have been outsourced to China. It might have been outsourced to certain players in India. And if BASF as a group has decided to outsource something, it wouldn't outsource it to BASF India because there is a certain reason why it goes outside of the entity. Whether it is technology, whether it is cost competitiveness, we can always discuss about it. They are all individual cases. But this contract manufacturing that we do with third parties is a group decision, and there is good sense why it is done that way. Now, like I've tried to explain this several times to several people. The challenges that portfolio like BASF faces in India. Like I mentioned a few minutes before, people who are in the refinery and cracker segment and cracker downstream into polymers, that is polyolefins or polyester PVC, for them, there is sufficient opportunity to invest. Over the last 5 years, a lot of capacities have been added. And I would hazard a guess that over the next 8 years until the end of this decade, we will need probably a cracker every year and its downstream polymers as an economy. Now, when it comes to the extreme downstream, what you refer to, whether it's ag or whether it is pharma API synthesis, here again, India has positioned itself, and many of the players that you talked about have positioned themselves as global suppliers to various generic molecules and as well as contract manufacturing for a few, let's say, originator molecules. The Indian downstream chemical industry has positioned themselves. But during the COVID, you also realize that many of these companies have challenges because they need to buy building blocks either from China or from Europe, and this became a huge challenge during COVID, during supply chain crisis. Now, when you look at BASF's portfolio, we are somewhere in that in-between space. Any big investment from BASF, whether it is in the chemical segment, whether it's in the chemical intermediate segment, or in the monomer segment, which are the larger things. If you look at our overall segment structure, in the material segment, we are well invested, whether it's engineering, plastics, or polyurethanes, and this will be incremental investments every time there's an opportunity. In the industrial solutions, also you see us having invested in dispersion and pigments, and also in the performance chemicals. Now, the key issue is for these big building blocks, whether they are in the petrochemical segment or the monomers or the chemical intermediates, which is where all the big commodities sit. That's where it becomes interesting for BASF. I think we still have some time to go before India becomes a market large enough for an investment of BASF size there. I hope I answer your question, Rohan.
Yes, sir. That answers few part of it. I fully understand that it will not be as in black and white as you rightly mentioned. Just one small clarification. In agrochemicals segment, we have seen a huge jump in profitability in the current year. Just wanted to understand that what has led to these changes in a margin improvement in the agrochemical business. Is there any particular product driven, or in overall that we have benefited from the backward integrated, or I mean, what is driving this profitability?
It's a combination of factors. Well, firstly, there's a portfolio effect in there. So certain products, new products, like I mentioned, now going forward, we further look at new products. And I mentioned that in another question earlier, we are also looking at in the context of the PLI schemes as to what should be our supply chain and manufacturing strategy going forward, because the external environment is changing quite dramatically, and I think this will develop further, and we as a company need to reevaluate our supply chains and manufacturing footprint in the context of AgChem. And we will do that. So when there's something, we will come back and announce, but as of now, it's at an evaluation stage.
Thanks, sir. Just last from my side, I'm sorry. On capex front, I didn't get you. So if you can give some number and guidance that what as a group you are planning to invest cumulative over next 18 months or 2 years time frame.
So at the moment, we have a few capex projects running, and they are around 100 crores, order of magnitude, over this time frame that you talked about. That's in, but that covers a lot of things. I mean, it is replacement, it is repairs and maintenance, upgrades of several plants, some debottlenecks. So it's a combination of several projects. It's not like one large project which I can make an announcement. But like I said, let's come back to you when we have more news, and as and when we do have a decision, we anyway publish this out in the open to you.
Absolutely.
Wherever we have. At the moment, it's a lot of debottlenecks and energy projects to improve our energy footprint. Those are the kind of capexes I'm having. We just expanded our capacity on Celastro. We expanded our capacity on dispersions. We also did something on the engineering plastics and polyurethanes. We do have capacities available at this point. So I think from our local portfolio perspective, we are good to grow. Our capacity utilization has improved over the last couple of years. And we are at a point where we have to now evaluate whether we need something more. And when we have something, we will come back and announce it.
But in the cash flow in the first half, your capex number only talks about close to just 32 crore rupees investment. So I don't know if that is a part of this current year, and you are only looking 100 crore rupees kind of total capex. A company of 1,000 crore rupees EBITDA with the 100 crore rupees investment looks quite meager. That was my earlier question was also that. So either we will be waiting to hear more aggressive plans from the company whenever in the due course. Because I mean, that's what I mean. Ultimately, your industry is a capex-led industry. Unless you don't invest the money, probably we will not see the growth. So that was my question. Was even in a first phase also where I tried to explain that where is the capex? You are generating huge cash flow. Why the company is not investing in future? So that's it from my side. And thank you very much, sir, for being so patient and answering all the questions.
Thanks, Rohan.
Thanks, Rohan. The next one is Chintan Cheda. He's from Quest Investments. Chintan?
Yeah, hi, good evening, and thanks for the opportunity. Sir, I have one question on the Agri Solutions segment. So how many products we have launched this time for the winter crop? Because generally what happens is that Q3 is the weakest for us in the agri chemical solutions, and there we end up reporting loss in Q3. So what is the outlook for this time?
So I won't give a forward-looking statement on what's the outlook on profitability for Q3. But the two products that we launched earlier this year, so one was in April and the other was in June. So we had launched Westnet Complete in April and Exponus in June. So these will be the products which will also continue along with the rest of our portfolio into Q3. So between Q2 and Q3, I mean, in this quarter, we don't have another product coming out.
Okay, got it. Thank you.
Thanks, Chintan. The next speaker is Ranjit from IIFL.
Yeah, hi sir. Hope I'm audible.
Yes.
Yes, Ranjit, go ahead.
Yeah, thank you, sir. Thanks for the opportunity. Again, circling back to the same questions, I know we are trying our best to kind of extract an answer from you. Probably a couple of years back, so the question was never about our capability. It was always about whether we have a serious intention to expand in India. A couple of years back, we did have this financial challenge, and probably that could have been the reason why we won't have aggressively expanded. Now, even that is solved, we are generating a handsome EBITDA. And whenever we kind of pose this question, we get the answer that you are probably looking at a critical mass in India, which would drive your next set of expansion. So my question is like this critical mass, whether this is an absolute basis in India or it is on a relative basis to China. The question why I'm asking is that we have seen in the recent past our parent company announcing an expansion of almost a $10 billion kind of an expansion, and we seems to be getting into the Verbund site in China. We already have one. We are like looking at having a second Verbund site over there. So if these are the kind of investment that we continue to do in China, so if our decision is on a relative basis, then we will continue to have this gap on the critical mass, the make versus buy kind of a decision. If we, as an Indian entity or at the parent level, we want to get into, I do see that it would be a delayed thing, probably on a foreseeable future. I don't think we would be entering into that critical mass if we tend to compare it with make versus buy. So just wanted to get your sense. How do you see this critical mass, whether this is on an absolute India basis or it is always been in comparison with our Chinese investments? Thank you.
Thanks, Ranjit, for that question. It's an absolutely perfect question to ask, legitimate. So the comparison always is what's a global economic scale of investment versus the domestic demand. So it's an absolute comparison of that. So a particular technology needs a certain scale to be commercially viable. And that's where, so it's not a comparative of whether China or India. So when India provides us with a suitable, and I can list a set of, I had the same discussions with the ministry, by the way, a couple of months ago, where we listed out a set of products where we said, these are the kind of products that we look at where there is no plant in the country. So 100% of it is imported. And why is it? It's not just BASF, but it's across the chemical industry. Nobody has invested here for these portfolios because there is no critical mass. Now, that is regarding the new portfolio. For our existing manufacturing portfolio, we continue to invest. And we will continue to expand capacities as the market grows. So whether it is engineering plastics, elasto, polyurethanes, dispersions, coatings, wherever we have an asset base already here, we will continue to do capex. But these are plants where every 3 years or 4 years you might need a capacity expansion, because we do have a certain position here. We saw the critical mass and we have invested in those areas. Now, when it comes to the bigger parts of the commodity portfolio, that is where I'm saying that if you want to see something different altogether, there we don't have the critical mass as a country, and which is why not BASF. Nobody has invested in it.
Sure, sir. So if we probably the PLI would be one that trigger that we are looking forward to, probably that would provide the critical mass or at least the incentive part to go ahead with the investments into India.
And Rajit, that's a very interesting topic again. It's not just PLI for chemicals. What do I do with the PLI for chemicals if there is no demand in the country?
Right.
The demand in the country has to come from my customers. So I'm more interested in looking at what is the PLI for my customer industries, because that triggers demand for my product. I'm happy to take a PLI for chemicals as well. But unlike what we spoke about so much, the exports of agro, exports of pharma, when you come to chemical building blocks, there I need that my customer industries get the PLI. And what we've seen in the 16 or 14 PLIs which have been announced, 16 overall, but 14 have been more detailed out. We see certain positive impact on our downstream customer industries. And this will generate demand for us. And then it makes sense that we have our investment criteria.
Yeah, right, sir. So one of the thing we keep on hearing is of the new age chemistries or new age user industries altogether, which India didn't had in the past decade, or there is going to be a potential growth, be it EVs or be it green energy. And here, at least, we don't seem to have very large plants in China or across the world. Would that be one of the segment that we can drive a growth?
So from the EV perspective, you must be aware that in the BASF portfolio, we do not manufacture cells, but we are active in the space of cathode active materials.
Right.
And here, clearly, we are just seeing the initial stages of the gigafactories being built in the country. And obviously today, a lot of it is through imported components. Once these factories are built up, this should create sufficient demand for the cathode active materials. But there again, you need a critical size. And I think one can argue what will be the penetration of EV in the country, both for two-wheelers and for four-wheelers. And if you ask the different consultants, you get different data. But principally, one thing everyone is aligned on is by the end of this decade, that industry will be large enough and there will be sufficient space for cell manufacturing in the country. Now, in the PLI schemes on this advanced chemistry cells, you must have observed that there is a certain local indigenous component that is required to be achieved within 5 years, if I'm not wrong. And to achieve that component, again, all parts of the cell, whether it's the electrolyte, whether it's the cathode, whether it's the anode, all of them will need certain level of indigenization. So I think that is an area where there is opportunity. You also saw recently, I mean, for a country which uses so much of electronics, not having any semiconductors being manufactured, and now recently you had this announcement of the Vedanta group with Foxconn setting up a semiconductor plant. Now, these are areas what I talk about, which then gets interesting because then they need those chemicals and the specialty chemicals in bulk. And probably you need 3-4 of those to come in before you get to the step where, you know, it becomes BASF's portfolio large enough, because with just one unit, it's not good enough. This will have to be done via imports. So like, let's say we have just one cell manufacturing plant for EV in 5 years' time. This is not good enough to have the back-end chemicals to have economics to compete against an imported cell from whichever part of the world. So you need 4 or 5 of these gigafactories to come up before you start the components as well in a local setup. So very much, Ranjit, these are topics of immense importance and discussion within BASF Group, and exactly what I talk about, that when the industrialization of this country happens at the rate which the government is projecting it to be, there will be significant opportunities to look at our portfolio and invest here.
Thank you, sir, for patiently answering. One last bit, in your interaction with the parent company, you do see them quite open to these investments whenever this critical mass would be there in India.
That's right. I mean, if you have a critical mass in the country, you have an economic case, having a reasonable rate of returns. The parent is very much interested in investing in India. Now, a couple of you talked about the last 3-4 years that I've been here in this position. I mean, we've done, like you noted, and Naren also presented in the charts about how our business has grown over the last couple of years. And I must add here that the parent company sees BASF India as one of the high performers within our portfolio of companies across the world. And yes, there is a very positive sentiment in the context of the business in India and possibility to expand further here in the country.
Thank you, sir. Thank you for answering all my questions.
Thanks, Ranjit. Again, if there is any question anyone would like to ask, please raise your hand or put that in the chat box and we'll be happy to answer. There's one question, Mohan, which has come from one of the analysts, and this is: which segment do you see in our portfolio in a 2 years horizon, which has an optimistic outlook, and which are the ones where you see they may go slow. Again, this is a forward-looking question, but in general.
But I will stick to my previous statement where I said, I mean, I don't see a 2-year horizon. I don't give a statement on 2 years today. But at the moment, what we are seeing is the automotive segment is quite positive in the country, and the outlook from the automotive industry is also positive. A lot of new car launches, also the premiumization of the cars that I'm talking about, the two-wheeler industry. This is quite positive, the development, and many of our segments have some kind of inputs in the automotive area. And there I see a positive outlook also going forward. I see ag as a positive development over the next couple of years. We see the industry doing well, and also we have a few products, I mean, which are under registration. The new products coming out will have a positive impact. So these are two things which I can talk about. The others, I mean, it's more short term.
Okay. Any other questions from Varun? Are you there? You had some other questions which you wanted to ask.
Hello?
Yes, Varun, please go ahead with your question.
So my question is in the context of investments. So how has the 5-year capex plan changed for BASF India versus what it was, say, 1 or 2 years back? Is there a meaningful change there?
Meaningful is a very relative statement. So yes, when I look ahead, the 5 years, let's say, plan and ideas, we are a lot more optimistic about the Indian economy and the overall industrial part of the Indian economy than we were, let's say, back in 2019 and 20. So in that context, we are a lot more positive today than we were back in 19 and 20.
Okay, and what amount of capex can we independently decide and execute? So what I want to understand is how much are we dependent on our parent company in deciding the quantum of capex? That would be helpful to understand. So is it 100 crores, 200 crores? Beyond what size we have to sit and discuss with our group?
That's I mean, globally within BASF, anything over 25 million euros requires a board approval from our parent company.
Correct.
25 million euros is the threshold.
Okay, all right. Yeah, that's it from my side. All my questions have been answered.
Thanks, Varun.
Thank you. So there are no more questions from the chat, and also there are no hands raised more.
Good. Then, if there are no further questions, sincerely thank you. I mean, it's always nice talking to you, and you know, I really get some interesting questions, which kind of sets me thinking about what to do. So, in principle, thanks for a lot of support and guidance. What I get from you also is areas where I should focus a little bit more, and thanks very much. And I see that if I can summarize today's discussion, is that you are happy with our performance over the last years. However, you would like us to look at more in the context of what do we do for investments and future growth. So that for us is homework. So thank you very much for all those inputs, and look forward to talking to you again. Have a nice weekend.
Thank you.
Thank you.